Much, Andrew. That was great. Thanks for having us here. We are going to talk about self-funded search, and we're so pleased to see so many people joining us today. So we are going to talk about a few topics that we don't really talk about a lot at the conferences. So first of all, I thought I'd share what we decided not to talk about. So we decided to, right off the bat, not talk about the LOI process, not talk about pre-LOI analysis, not talk about the elements of getting the deal done, not talking about how you find deals. We find that from the standpoint of traditionally funded searchers or self-funded searchers, the kind of LOI analysis process is very similar. There are going to be a lot of the similar concepts with self-funded and traditional and conventional and how you look at your LOI and that analysis. So we're not going to talk about that. So I'm going to introduce the panelists, have them go through their introductions, and then I'll share what we are going to talk about today, and I think you're going to be real pleased about it. We're going to talk about a few of the mysterious elements of self-funded search. So with that, I'm going to have Kat, why don't we start with you, and you can give us your intros, and we'll go down the panel here.
Fantastic. So my name is Kat Littell. I am currently with Halstatt Legacy Partners. I've been investing in search for a good number of years now, both in sponsored search, traditional search, and self-funded search. I am the partner of a searcher and operator, so I've been in the search ecosystem for 15 years. So that's me in a nutshell.
Hi, everyone. I'm Aizik Zimerman. I'm the CEO of Blanton Plumbing. We're a residential plumbing company here in Chicago. I did a self-funded search about 13 months ago, acquired the business, and now run it. I'm also a Booth grad. I graduated in 2023.
Hey everyone, good to be here. My name is Chris Williams. I run System 6. We're an outsourced accounting, finance, back office business, so we do kind of controllership and below. I ran a self-funded search to acquire the business. I was GSB 2020 and spent a lot of time thinking about traditional versus self-funded, so happy to talk about that as well. And we serve a bunch of search acquired businesses now as well, so that's been a fun journey for us. And I bought the business just over 2 years ago.
I'm Brian Axelrod. I'm a partner at HMB Legal here in Chicago. And we've been involved in search for 15 years as well, going back to the financial crisis is how we got sort of into it. Historically, have done a lot of traditional search, but also as the market has really grown, also do accelerator sponsor search and self-funded search, which is why I'm here. On the self-funded side, we tend to see some of the larger transactions where you're maxing out SBA facilities, even doing companion loans. So that's where we see Live Oak a lot. And also happy to be here.
Great, thank you for that. So some of the trends, as the nation's #1 SBA lender at Live Oak, and we have our specific search fund lending vertical at Live Oak, and my colleague Sarah Andrews is also here as well. We have noticed over the last 3 years, 2 years, a real modernization of how the SBA lending program works, especially for our self-funded searchers. We spend a lot of time at all of our business schools. It has really professionalized over the last 2 years in particular, especially with the capital providers, SBA lenders that are specifically specializing in this, and the evolution of investors that are understanding and desirous of working with self-funded searchers. And then also just the service providers, Q of E providers that are specializing in sort of Q of E lights, and then also attorneys that are specializing in how to help searchers with pre-LOI, and especially now, because we have such an inclusion of investors in our self-funded search deals, we have attorneys that are also specializing in how to facilitate the equity process. And that has really modernized how an SBA loan can be used for, really smart, ambitious people. So we're just so excited to have you all here today. So we're going to talk a little bit about why self-funded versus maybe traditional or the accelerator model. We're going to spend a little bit of time on that. Mostly at this point in time, everyone kind of knows the differences there, but we're going to have people share their personal stories on how they sort of found the self-funded path. We're going to talk about how bank financing works, just a little bit. I think there's so much information out there about how an SBA loan works, so we're going to spend a little bit of time talking about that. Where we're going to spend the bulk of our time is talking about how the equity works. I think that's still a real mysterious piece, especially for our searchers that are just getting started. So we're going to spend a lot of time talking about the equity piece. And then this idea of post-close governance. You've got your loan, you've transitioned. How do you work with your investors and your bank post-close? So on that note, let's kind of start with the idea of the self-funded path. So let's start, Aizik, let's start with that. Tell us a little of your story, how you came to differentiate between self-funded traditional and why self-funded.
Yeah, so my background, I grew up in a family of small business owners, so I always knew I wanted to run and build a business one day. Before Booth, I had done a mixture of private equity and also operating, and I knew I wanted to run a business, and I was very interested in running a business over a multi-decade horizon and trying to build a big company. And so for me, self-funding a search was all about flexibility and control of my destiny. And I was also very obsessed and laser focused on home services, specifically plumbing and HVAC, and also specifically in the Midwest. And so because I wanted to control my destiny, I was focused on one specific thing. It just allowed me to have more control over that. And I think one thing people maybe historically think of self-funded search is maybe that means like a smaller business or your ambition has to be lower. And I think that that is a narrative that's really changing a lot. Like, I want to build a $1 billion company. That's been my goal from the beginning. And for me, self-funding was not to have a less professional or smaller company. It was to be able to be more creative in how I structured and what I focused on. And so that's what I optimized for. It just gave me more control over the end result of where I wanted to go.
Right. And Chris, from your perspective as well, I'm sure a lot of those comments resonate with you. Any add-ons to that?
Yeah, the way I thought about self-funded and really my search, and this obviously, like, the table stakes is if you're going to do self-funded, you know, you have to have a way to keep the lights on. Like, I was lucky to be able to do that. If you're going to use SBA, you have to be comfortable with personal guarantee. So, like, assume those are all the case. For me, it wasn't I'm only going to do self-funded. It was just, hey, I'm not going to raise money because that keeps my options open, and that gives me the ability to look at more deals, and then I'm going to use the capital structure at the deal that fits the deal. So honestly, if I had found, you know, $4 million of EBITDA that was going to be purchased for 7 times, and it was a great growing business that I thought I could hit that 35% IRR on, like, I would have been happy to do that deal. There's a lot of benefits to buying a bigger business. There's downsides to the traditional, you know, capital structure. But for me, it wasn't like I have to do self-funded SBA. It was just, I'm going to self-fund so that I can look at the smaller deals, look at more deals. And then the business I found was like $1 million of EBITDA. You know, that is right down the fairway for an SBA deal. I was comfortable with the personal guarantee. So for me, it was really just like, I wanted to diversify the deals that I could look at. But if you're going to do that, you have to be comfortable with the personal guarantee. Because then otherwise you might as well just raise traditional money if you're not going to do the SBA deal.
Yeah, that's great. So, Kat, in working with your searchers, do you invest in anything to add on your observations?
Absolutely. So when I tend to talk to folks kind of all over the spectrum before they really start raising a fund or where they decide what path to go down. And some of the recurring themes that I hear are around the constraints that they have in their personal lives. Do you have a constraint around a geography that you need to search in? Do you have a constraint around an industry that you want to search in? So I think when you're thinking about the path that you want to go down, one of the best things you can do for yourself is figure out how to define those constraints up front, because that will save you a lot of headache later on. So when you're thinking about, when I take a step back, when I think about search, it's a spectrum, right? It is a spectrum of risk. If you want to assume more of the risk, you get more of the equity on the backside. If you have more investors along with you, there is likely going to be things that you will need to give up on that end of the spectrum. So when you're thinking about the constraints that you can add to help maximize your time searching and not floundering on your different paths, think about how you can define specific criteria, very objective criteria, so that you can move forward very quickly and figure out that path. So I would say that in the self-funded space, we see a lot of folks with very specific criteria. I need to search in a particular geography. I need to search in this particular industry. To your point, Aizik, the spectrum of EBITDA that we're seeing in our self-funded deals are really getting a lot larger than we're seeing in some of the other aspects of our search investing. So we're seeing very, very small deals. We're also seeing deals that are well above 6 million of EBITDA. So, we are starting to see a lot more variation, and that creates a lot of really interesting opportunities.
Yeah, I think that's one of the myths, for sure, that takes a while.
Can I add one more myth?
Yep, of course.
Think of, you're looking at one right here, but I think that there's a ton of good investor support behind the self-funded search community, and it also doesn't have to be just at LOI. I had made a relationship with a couple of investors who primarily actually do traditional investing. They're individuals. We may actually share some investors, but I was kind of like, hey guys, I'm going to search. Can we talk once a month in a very similar way that they're talking to traditionally backed searchers? It's a good deal for you. You don't have to put money in now. We'll do a deal together when it happens. So you can still, you got to work for it, but you can still get the mentorship during your search. Of course, it's not as resourced as some traditional ecosystems, but you can have, I think, a pretty similar cap table, a pretty similar support network during your search. You just got to kind of do it more on your own, but it's not like you're just going to be, in your office searching by yourself.
Yeah, and we see a lot of cap tables from across the country in lots of different regions, and I think you might be surprised at what names pop up in people's investor cap tables. It's really cool. Well, thanks for that. That's a little bit of a kind of a preview into some of the other things we're talking about. And I think it'll become even more clear with some of the topics that we're going to get to on if self-funded is a good path for you. I think it'll become clearer and clearer with some of the things we talk about. And then we'll get to you, Mr. Axelrad, pretty soon. So let's just segue into talking a little bit about how the debt works. There's so much out there through all of the various platforms, social platforms. We have office hours. There's a lot out there on how the debt works with SBA. So let's just talk about it for a little bit, and then we'll move to the equity and then the post-close governance. So as the lender on the panel, I'll just give you a snippet on how the SBA works. Again, there's lots of details out there about how it works already, so we'll just do high level. So from the standpoint of SBA lending, which for purposes of our discussion, let's assume that's how the self-funded searcher is going to finance their acquisition debt-wise as SBA. But as Kat suggested, there's larger EBITDA deals out there that may not be using SBA financing for. A lot of lenders have a senior SBA with a junior conventional piece behind it. So an SBA can fit sort of an $8, $9, $10, $12 million enterprise value deal, but just because you're self-funded doesn't necessarily mean you have to use SBA. But for the most part, that's what we're going to be using. So I think it's really well known that it's generally around 10% down. And that equity is from you and your buy team, so 10% equity. Generally, industry standard is 10 to 15% seller note, second position to your bank debt. And then the SBA is doing somewhat like a 75 to 80% financing. That's sort of how the SBA has worked for many, many decades. The reason that the SBA loan is so compelling is because you have a 10-year term, fully amortizing SBA loan. That 10-year amortization and term really allows you to afford quite a bit of debt. So these are meant to be highly leveraged transactions, although as the lender voice on the panel, you don't have to always maximize your debt, but that's generally what people are doing in the SBA context. And we are looking at historic ability to pay, so the company as is, their ability to afford and pay for that debt at a debt service coverage that works for your lender. Live Oak Bank, we want 1.5 debt service coverage or higher. So 10% down, that term allows you to really get there. So that's SBA in a nutshell. So from the standpoint of the deals that you financed and that you see, if you're all willing to maybe share an example of an SBA structure that you've seen, maybe with a deal that you've worked on.
Yeah. So I represent a family office. I invest on behalf of a family office. We are a little bit more structured than some other investors, and I think that is also a topic we'll talk about a little bit later. But in terms of how I review deals and how I think about investment structures, I like to stick to the 80-10-10. Deals that fall outside of that take more time. Let's be honest, it takes more time for me to review deals that fall outside of a standard structure. I review hundreds of deals a year, so I need to be very thoughtful about how I'm using my time in evaluating these opportunities. The further you fall outside of the quote-unquote standard structure, the more difficult it is for me to evaluate that deal. Not that I can't, obviously, but I have a lot of other deals that I'm evaluating and comparing. So I'd say the vast majority of our deals actually fall within a very similar structure. It's the 80-10-10. We have typically between an 8 and 12% preferred return. That typically translates to a 20 to 50% equity stake. It's a super huge range. It's calculated. We can go into the math later, but they typically fall within a standardized structure of things that we look at.
Great. Aizik, you willing to share your details?
Yeah, so I think this is the cool thing about self-funded is it's very much a choose your own adventure. So my deal was not standard at all. I'll say first, personally, I don't believe in highly leveraged SMB transactions. So actually Live Oak is my bank. I did get an SBA loan, but I raised the entire purchase price in equity and took a loan. So I have excess cash on my balance sheet for growth. And I think that comes back to what your goals are. I wanted to build a large, fast-growing business, and so being highly levered while you have more equity actually goes against growing fast. Because Chris and I were just talking about this before the panel started. If you want to grow, you're going to tank your EBITDA in the early years. This is J-curve, and it's very difficult to do that if you are 90% levered. So first of all, I didn't use that much leverage. Number two, what was different about my deal, I was the largest investor in my deal, but I did raise outside equity. So I own about half the equity of my company, but I do have controlling shareholder rights, and my investors have effectively minority investor protections. And I took, I guess you could call it carry, that would look more similar to a private equity type deal. And I think also people are used to a structure in self-funded too, which is maybe highly levered, a preferred return to investors, and then the searcher ends up owning, 80% of the equity without putting up any of the capital. And I structured mine more as a high growth company with a long-term hold. And what was super important to me was the ability to grow fast by having resources and having control. So I traded some equity for control and for having resources, which to me for me has worked out well. We were able to double in the first year, and that's my goal going forward. So I think you have to solve for where you want to end up, and that's where your financing will be. That's where your equity terms will be. And I think if you have a good background and a good deal, you can really shape whatever you want within reason.
Great. Willing to share?
Yeah, absolutely. So some similar themes here, some different themes, which I think, again, go to you can make it a lot more what you want, what's right for your deal. I did 75% just under SBA loan, 15% seller note. That's on standby, full standby. That's a term you might hear, but that basically means I don't owe any payments on that loan until 10 years, basically on the same term as my SBA loan. So that, to Aizik's point, decreases my principal and interest payments every year because I'm not paying out interest on that loan, and that has allowed me to grow faster and cut margin. Whatever your model is, assume EBITDA is going to go down, you're going to want to grow, you're going to have to spend more money that the seller had cut to get ready for sale. So build that in. And then 10% equity. I was about half of that, so kind of similar to you as well, and then raised the other portion of equity from investors. I think I probably could have scrounged together friends and family type stuff and raised less money from institutional investors and ended up with more ownership or more control in my operating agreement, but I was actually solving for, like, I want a board. So I have a board that looks more like a traditional search fund board, except for a few control rights. And I wanted that because I was like, I've never run a business before. I would really appreciate, like, the accountability of quarterly meetings, and also, like, 3 people with a vested interest, you know, then I can't sell my company without approval of the board. And yes, it means I have less control, but on the other hand, I'm like, well, if these big decisions investors don't want to do, I should probably listen to that. So that's kind of my structure.
Great. Brian, anything to add from your vantage point as far as debt structures go, if your clients are using SBA?
Yeah, I mean, I think the thing I like to just, you know, maybe this is counterintuitive, but as the lawyer, I want to keep it simple. And, you know, I tend to worry about post-LOI breakage, so deals that die with self-funded side of things, there's a lot of dead deals. And so sometimes it's kind of like the is this too good to be true side of things, where you may see an outsized seller note. And, you know, I try to ask harder questions in a gentle way to kind of probe about that, because part of this is really gets to the point of, like, what conversations have you really had with the seller? What conversations has the seller really had with their advisors? Do they really know what this says when it says full standby? A lot of people don't want to put that in the document, so it's just going to say something like subject to senior lender's discretion, which gives them the ability to point back to something later and say, well, I told you it was going to have to pass muster with our senior lender. But people didn't realize, okay, I'm not getting that money up front, and I may not see it because it's going to be subordinated to the bank, maybe for a really long time. You know, if we're going to look at a LOI for a self-funded deal, the more it can stick to the typical structure, like Kat was saying, the more I think that there's a good likelihood that that deal is actually going to close. Obviously, like, you got a lot of work to do after the LOI and quality of earnings and all that stuff, so it may break for other reasons. But breaking a deal because of structure alone is something that you can usually mitigate or put yourself in a better position if you're smart about how you do your LOI terms. So that's on the debt side. And just to comment real briefly on some of the comments around investors, I think just listening to the panel, you have folks here who, like, self-select into really having good, valuable investors because they're approaching it from the perspective of investors are value add. There's a lot of people who don't come in with that sort of intuitively. So one of the things I also talk about when it comes to structure is, okay, are you raising money? Who are you raising it from? What do you expect to get from them? Right? Because if you don't have smart investors, but they're still going to ask for control terms, it's a bad mix. If you have smart investors and they're asking for some rights, okay, you can have that conversation. If you're going to get smart investors and you don't expect them to ask for anything, you know, so our job at part of that process is really to try to see if we can see potential fault lines to flag and surface to make the process go smoother.
If I may add one thing on equity,
Sure.
too. I think one thing I've heard from fellow self-funded searchers, or a mentality, is a little bit of greed on the equity side. I think what Chris is saying, and a little bit what I'm saying too, is counter to that. I think I view building, at least my business, and I think a lot of these small businesses, as almost a binary outcome. Like, it's either going to be a successful enterprise, and therefore you'll make a lot of money, or it won't be. And so what can you do to stack the deck in the favor of having a successful enterprise? Whether that's more resources, a board, whatever it is. And if you own 50% or 65% or whatever it is, personally, like, I don't think it makes a difference. I think just focus on building a successful business, stack the deck in your favor to be successful, and I think you'll be happy at the end of the day.
Great, I appreciate that. And this is kind of segueing into this next section on the equity. So I'm going to have Ryan and Kat, I'm going to have you sort of lead this, and then
Okay.
Chris and Aizik, you can kind of chip in. But before we move on to that, I will tell you the J-curve is real. It is real. I know we talk about that on the traditional side, but it is real in the self-funded space as well. And maybe it bites even a little harder in the SBA context because you're starting generally with a little bit more leverage. So J-curve is real.
Lisa,
Just
does
want you
everyone
to
know what a
direct
J-curve is?
that. J-curve is your EBITDA starts here, and then you buy it, do some things to it, and your EBITDA goes down. And then it comes back up at some point in time. It's called the J-curve, and it is real. Your EBITDA generally, for most deals, goes down because you're going to invest in that company, or your transition turns out a little bit differently, and sometimes the EBITDA you thought you bought is not the EBITDA that you actually acquired. So well, I think there should just be a lot more discussion about that. Okay, so that's my one little soapbox. So I'm going to move on and for us to dive further into the equity piece. So, Brian, you were kind of talking about common structures. So why don't you lead us through what are some common structures for the equity? Like, common standard versus maybe customized, and then Kat, you weigh in as well.
Sure, I'll stay at a high level because we could obviously dive deep in this, and then obviously we can see how the discussion plays. But when you raise money from investors, investors are going to expect to get their money back before you get something most of the time. That's at least the investor expectation. There's also tax issues related to what would be considered, a tax advisor would tell you, is a capital shift. So if you take money for something and it's an even 50-50 split, and you split those dollars 50-50, but you got something for value, for not paying for it, the IRS may say that you have phantom income. So there's both tax reasons that benefit the operator as well as investor expectation that may push you towards a preferred structure. And Kat mentioned preferred return. So and technically people think it's like money back and then you get your preferred return. Actually in the waterfall, it's first the return because it's like interest. You pay the interest down first before you reduce the principal, if you think about it in those terms. So that's the way the waterfall works. And then separate, just to talk a little bit about what Aizik was talking about is, and this actually gets back to something Chris said at the beginning. When we first got into self-funded search, we were working with self-funded searchers who could have raised from traditional search sources, but just chose not to. For part of the reason that Chris was saying, greater flexibility, or just they didn't need to raise the money. And so over time, we saw those structures more from the perspective of the traditional search lens. And then over time, there's been this, I would call it radical shift in the market where searchers on the self-funded side expect to own upwards of 100% of the equity in a business. In fact, I didn't go to the panel, but there was a panel at the HBS conference last weekend, and I had to go home to put my kids to bed. But I asked somebody to take a picture of any of or take notes for me, and he said that the self-funded panel basically was like 70 to 80% equity for self-funded searchers, no question.
Right.
And I think, if you think about that from an equity perspective, you have people on the traditional equity side of things who are, okay, 25% for a solo search, subject to maybe supercharging returns if there's much greater outsized returns, or 70 to 80% on the self-funded side. That's just a wide chasm in terms of perspectives, and very few people put it in the context that Chris said earlier, which is, I'm thinking about the value that comes from the people who are providing the equity to drive me towards the business I'm going to find, and then the equity structure is like the tail wagging the dog. I mean, I think, Kat, you would agree, you never want to be in a situation where you have friction with your investors around terms. And it should be natural that there should be sort of a general understanding of somebody who knows things in terms of minority protections and, tag-along rights and rights of first refusal and those things that are just sort of common to everybody in the structure. But then some people approach it as like, I want my investors to have no say. I want to have most of the economics. They're just along for the ride. They're passive, silent investors. And so a lot of the structures we see are driven a lot by the personality of the people involved. And I think it benefits people to kind of step back and say, where's the value coming from? What are you really expecting people to get? So a little bit of a tangent there, but I don't know, Kat, if you want to weigh in on that. Or Aizik, you might.
Yeah, I think that's super well said. I went through this exact debate early on in my search, and when I was fundraising and thinking about it, I think some of it too is a function of how much money you want to raise and who you want to raise that from. That model where it's 70 to 80% searcher retained equity, that's the model where this is generally true, like you're highly levered, you're raising a lot of checks that are smaller checks from a diverse group of people, and so you're able to drive more towards that outcome. And that's just a different investor base, it's a different amount of capital you can typically raise, and it's just a different structure. And then I think on the other side is something more similar to a traditional search, which is kind of what Chris and Brian referred to. So personally, like, I don't like the extreme end of the model where the searcher retains the majority of the economics, because I think it leads to decision making that isn't optimal for the business.
So I'm going to add a little bit of context to what everyone has said. And I think really depends on where your gaps are. Is your gap on the sourcing of deal? Is your gap on the closing of deal? Is your gap in the operations? Is your gap on the exit? What phase of the lifespan of the search do you want the most support in? And then you should think about your cap table and your LPs and your investors as how can you best support yourself throughout those different parts of the deal structure and the operations of the business. So that is, building off what my co-panelists have said, is that you really need to think about who you want to have along with you for the ride. If you just want silent capital, you are going to self-select into a certain subset of people. If you want to have help, you need to think about when and where and be very specific with your investors about where that help is needed, and you need to ask for it. So when we're thinking about equity structures, for me, I think about, quite frankly, I will vet out people fairly quickly in my vetting process if they cannot articulate something that they need help with. If you just want capital, I'm not going to be the best person for you. So thinking about that in terms of what support I need, what am I willing to give up in order to get to that support? Now, in terms of equity, I've said this on a number of panels, it should be, in my opinion, a calculation. You need to think about the risk associated with your business. You need to think about what return structure, your debt structure. You need to think about what your expected growth is going to be. You need to think about, are your investors going to be looking for distributions along the way? Or are they looking for exit in 5, 7, 10 years? What is their time horizon? Are they patient capital? Are they capital that needs to have a return within a particular time frame? So all of that goes into your model. Your model matters very, very much. And as an investor, I'm going to pick it apart in a very loving way, but I'm going to pick it apart to make sure the J-curve is in there and that you're accounting for your expenses and everything lines up so that we can think about equity in terms of risk and how that risk is equitably distributed for everybody.
Yeah, I think just to add that, I had a similar experience when going through my deal. It was not about how much I was going to own and how much they were going to own from my investors' perspectives. They were like, okay, they wanted to look at the underwriting. They weren't just solving for, okay, you can own 75%, that's fine. They're like, okay, if you want to own 75%, that's what I own. They were like, well, what do I make in these 5 different scenarios? They wanted to, pay attention to, how much, cash we put on the balance sheet. It's not as simple as just, you're going to do a self-funded search and you're going to own, whether it's 50, 60, 70, 80%. It's very much kind of like a plug in a lot of ways based on the model, based on the structure.
It is absolutely. And there are some very simple ways to think about it. I've seen a number of different calculations that say that investors get a 2x step up on equity and things like that. It's not my favorite way of doing things. I really think you need to be a little bit more thoughtful about that when you speak to your investor base to figure out how to get to the appropriate equity distribution.
And you've got some equity metrics down here.
I do have some equity metrics here. Absolutely. So, so in terms of, so Brian had mentioned that preferred returns are paid before preferred equity. Senior debt always paid first. Always pay your lenders first.
Please,
we
really,
love them very
before
much.
Rent, for anything.
But in terms of preferred coupon rate, we typically see between 12 is on the high end, 15 would be great, but I don't expect it. But between 8 and 12%. And again, it goes into a calculation, but I would say typically is between 15 and 40% would go back to investors. On a standard, typical deal, there are a lot of deal structures where that doesn't make sense. But for me, and I know another set of family offices, we typically underwrite to over 30% IRR. And that is because self-funded deals, for better or for worse, are typically very risky. There is a high breakage rate of self-funded deals in market. And so we have to pull all of the market statistics in when we're thinking about our underwriting.
And Robert Graham with SIG was going to be on our panel to give a little bit more color around what SIG is doing from an investor standpoint. Mr. Self-Funded Search, Robert Graham, has a stomach flu, so he couldn't make it today. So Aizik and Chris, do you mind sharing a little more on what your relationship is with your investors?
Yeah.
Numbers-wise?
Sure.
If you're willing to share.
I have an 8% pref It is not required to be cash pay, so it's PIK. Like right now, I'm choosing to put that cash on the balance sheet or reinvest in the business. And then, yeah, we pay off, in a liquidation event, we pay off the accrued return, then you pay off that principal balance, and then we're at about a 75-25% split common to versus investors. My math gets a little wonky because I'm also in that preferred, which sometimes you do see if you choose to invest in your deal, but roughly speaking, 8% pref and 75-25 split.
Do you have a catch-up?
It's funny how much you forget when you're running the business of like what was in your operating agreement that you thought that mattered. I don't think so. I don't think so.
So for better or for worse, I was very allergic to the idea of a pref. So I was very focused on, again, like a multi-decade horizon, not paying distributions for a long time, and just trying to build and compound a business. So just personally, I didn't want to do a structure with a pref. So I have no pref. I ended up with probably less common than a traditional. Again, I invested I'm the largest investor, so I have a decent amount of the pref equity, but I ended up with less common than if I had done a structure more similar to Chris's. But so I have no preferred return. My equity vests day one, and I don't economically benefit from it unless I return capital. And then as long as I return capital, I economically benefit from my equity. And I control when capital is distributed, either through a liquidation or repurchases or dividends. So yeah, I mean, that's the structure that I was solving for, was focusing more on MOIC over time and less on a yearly IRR.
And Aizik, when you say you don't have a pref, you mean you don't have a percentage return. You still return investor capital first?
I have to return investor capital first, including my own.
So the range is kind of staggering. How this can actually play out in lots of different ways. So part of our comments here were just to give people a sense of how this is working and can work. Well, let's shift gears a little bit. So you're in operating the company, and you are in post-close governance. How does that look, Chris and Aizik? How has it been going over the last year, almost 2 years for you, Chris, right?
Just over.
Just over 2 years. And Aizik, 1 year, you're in. How has the governance been working with your investors? How does that look?
I would say, again, because of the nature of my deal, I have a very low-touch governance approach. So I send quarterly updates to my investors, and to the extent anyone wants to have a conversation, I'm always available. I do have a small board. We should get in the cadence of meeting quarterly. I think we're going to get more into that cadence. But to be honest, it is very low touch on my side.
And do you like that?
I do like it. I do like it. It's more of the model I was solving for, although I think over time, as we get larger and we have, I don't know how to say it, but like maybe like more interesting decisions to make, I think my board activity will increase. Because I mean, I have a very interesting board. Like, I like the people a lot. They have a lot of value to add. It's just in my first year, stuff changes so rapidly. Things are so micro that it's hard to do even quarterly planning that benefit that way. So I do a lot of like more informal conversations. So I think that activity will increase over time. But like, yeah, I do have a low governance approach. Again, like all my investors have protections. Like some of my family members are my investors, so like I care a lot about protecting everyone's money. But I don't have as formal of a reporting and governance as maybe a traditional search deal, or maybe Chris will talk about his setup, but maybe even his.
Yeah, and also like similar experience in the first year. Like our cadences were not what they were. Our cadences now are not what they were. Overall, but kind of still relatively low touch. So I do have a quarterly board meeting, but like, let's be clear, like for those of you in, private equity or whatever, this is like, my board materials are nothing like what, you would expect in a private equity owned business. This is not a 50-page deck. For me, like the preparation for board cadence is usually 10 days before it's that weekend, and it's the first time in 3 months that I've sat down to like think big picture for a little bit, to like check in on some levels of detailed financials that I'm not looking on a monthly basis. Like this is not at a level, maybe it should be at a better level of sophistication. I want to hear from you on this, but like, but it is, for me, I find it very helpful to take a weekend to look at some numbers in a way I haven't looked at over the past 3 months, and then also think about what were my wins over the last 3 months, what did we struggle with, what do I want to do better over the next 3 months. So I find those 2.5-hour conversations pretty helpful. It's good to get gut checks from people that see a bunch of other businesses, and they tell me, you are doing well there, don't beat yourself up, you need to be doing better there. So I find that kind of quarterly check-in helpful, and we usually have a couple of things we're talking about. And then, if I need board members, they're very available, and I've been surprised how available they are throughout the quarter. They're usually writing bigger checks than my business. And when I have something specific, you send them a text, you send them an email like, hey, I'd like to talk the next day. And I haven't had the experience of like board members really hard to get a hold of. That is something that's starting to happen in the ecosystem. So just, I guess, pick your board members who you think are going to spend time on you. I don't send monthly reporting, so we just do quarterly reporting. And then, I guess from a governance control rights, they definitely have protections in there around majority decisions and things like that. But again, I sort of view that as fine, because like, we should be making decisions as a group. It shouldn't be me versus the board.
So we've got the rogue operator response. What do you think, Kat, from the investor standpoint?
I love numbers. So look, we have a fairly sizable portfolio, and of the folks that have been operating the longest, we have gotten into different cadences. So at the beginning, it tends to be a little bit more, get your feet underneath you, figure out what you bought, and you're trying to figure it out as you go. As you start to get further along your path, I highly recommend that you start putting more structure in place so that you can keep a better handle on your business. Those monthly touch bases, while they make me feel a lot better, it is actually not necessarily just for me, it is for my operators. They need to have a better handle on their business. They need to understand their KPIs. They need to understand the metrics of how their businesses are doing. So we can spend less time at the quarterly board meetings if I have a monthly touch base with my team, so I understand how things are financially doing, my metrics for sales, my metrics for the balance sheet. If I understand how those are working, my quarterly board meeting is not spent in the business, it is spent on the business. And that is a very large distinction of how we can help those businesses grow. And when we work together to figure out strategic initiatives, how can we reallocate capital? Hey, do we need to cross-train that person on this particular thing? Hey, you're looking at an investment in this one particular area. Or, hey, what ERP should we be looking at? Those conversations are going to drive the business forward faster than spending 90 minutes once a quarter talking about balance sheet day sales outstanding. So I would highly recommend that when you start getting into the operator seat, build out those metrics, build out those dashboards so that you can have a quick touch base with your investors on a semi-frequent basis, and then use those quarterly board meetings to really use the power of your board, because you pick them for a reason, hopefully, that you know what your gaps are. They're going to help you fill those gaps, right? So you can harness the power of your board and ask for things, ask often, and stay in touch with them.
Right. And I'm getting sort of the Q&A time frame coming up here. Brian, before we move on to Q&A, anything that you wanted to add from your attorney perspective when you get in that post-close governance?
Yeah, I mean, I would just echo what everyone said about boards, to the extent that thinking about, figure out how it suits you, figure out how you can work to develop relationships. This is a big topic on the panel I was on before this in terms of allocating capital during operations. I'm very pro-board. I've sat in on, I don't even know how many hundreds of board meetings. I've sat on an investment committee for an investment fund. I'm on my firm's board. Like, I've seen all the ways in which boards can be helpful in ways that you can't even imagine, but you have to do the work to nurture those relationships. If you show up at a meeting and you just bring something of first impression to boards, you're not going to get their best thought because they won't have thought about it beforehand. You won't have the most productive conversation. You may have people with different opinions, and it goes in a different direction because they can't get on the same page. It may not be with the direction you wanted to take it. But if you spend the time and energy to cultivate those relationships, and it's not just boards, it's also your lenders and other constituents or investors who aren't on the board, and just investing in that time to build the relationships is going to get you, it's going to meaningfully improve the odds of success that you can see, because it's not just what you don't know that you can figure out, it's what you don't know. And the blind spots, there's nobody better to have around the room or on the table. It's the people who know you, know the business, know the challenges you're facing, who can then point things out and say, here's things we've seen before where you're like, I wasn't even thinking about that. But that doesn't happen in a vacuum. It doesn't happen by just showing up once in a while. It's cultivating those over time.
Can I say one thing super fast? I think, look, in self-funded, you can, to your, this is kind of, this got me thinking about it. Look, you can like find a way to scrape all the money together, have no institutional, sophisticated investors, have no board. Like, you can fully just go buy a business and completely run it on your own. Like, maybe that's your personality, but I just, like, my opinion, don't do that. Like, get somebody around the table, whether it's a formal board or not, control rights or not, but just like having some level of sophistication around you, because like it is hard. Crap happens, and it's good to have people that have been there, done that you can call when something happens in your first 6 months. Like, just don't do it alone.
And it's lonely.
For sure.
It is super lonely being an operator, especially when you don't have a peer in the business. The smaller the business, the less management layer you have. So your board can act as a support to you, not even at the beginning, not just the beginning, but along their whole path of operations.
And someone who wrote you a check is more likely to answer the phone when you call.
We'll pick up. We'll pick up.
So just back to what Chris was saying in terms of people who aren't necessarily as responsive. It's just to have someone have skin in the game, right? Even if it's a smaller check, it might be more meaningful for them. It's going to develop that relationship, because that's an investment of theirs.
Right. Well, thank you so much. We really wanted to get across how the self-funded space is really professionalized and how SBA is really modernized on how we're able to get some really nice growth companies done via the self-funded model. So thank you very much for joining us. And now we have about 10 minutes for Q&A. I think we have some microphones out about. Yeah, sure.
I can be loud.
Yeah.
While we're on the topic of boards, I'm curious, I know the answer is probably dependent on every individual situation, but what do you all feel is a good board size? What's too big? What's not enough diversity? What are your thoughts on that?
Well, I'll just say it doesn't have to be an odd number. That's people always they think it has to be 3 or 5 or 7. It doesn't. So that's the one thing I want to just start off by framing. Even numbers are fine. Don't discriminate.
Don't discriminate against even numbers. Most of the time I see 5.
Mine's 4, and the 3 besides me are all search fund investors, but one I would say is more like the private equity sort of oriented search fund investor, although he operated. One is more, I think, like operator-friendly search fund investor, and then the third is search fund investor with industry experience, and that mix is intentional.
And also, you can invite whoever you want to your board meetings as observers, right? Yeah. So, I have some clients where it's like, well, I have, it's me and 2 people. I talk to them all the time. Why do we need to get together for a quarterly meeting? Are there other people you want to bring to the meeting? Could you get a room full of 5 people where everyone's opinion is valid and you can get input from others, advisors, smaller investors, your lawyer, your whomever? So, having a good dialogue and a productive conversation about the business to answer the questions you want answered, that's what you want, right? And so, obviously, if you have a 7-person board, you may not be inviting as many people to that because it's already a crowded room. But getting back to what Chris said earlier, a lot of stuff happens by consensus. I've been to hundreds and hundreds of meetings. Very rarely do we do a vote where it's decided where it's not unanimous, right? It's almost always consensus, and it's just everybody moves forward, but you have to have a good conversation to get to consensus.
And I would add to that to the point of having advisors or observers, sometimes it is better or easier to have people come give you that really interesting industry advice, but they don't want to have a fiduciary responsibility to the business. And so you can get the really interesting person to come join you, but they don't necessarily want, as much responsibility. But to the extent that you can do that, I highly recommend it.
And you can also try them out. I've had people who were invited to meetings and weren't invited back.
What other questions?
What are you saying, Brian?
Oh, Aizik, did you want to add?
I have 3 people on my board, myself included, so a little bit on the smaller side.
What other questions? Oh, yeah, please.
Hi, thanks for being here. My name's Lon John, doing a self-funded search in California. Hey, Lisa. I'd like to know if you have some tips about cultivating relationships with these investors pre-LOI or while you're searching, and if there's a difference if you're looking for value-add investors versus more on the silent minority side. It's really mystifying for me, so I'm glad that you addressed it. If you have any tips for self-funded searchers.
Do you guys want to go?
Maybe how the operators went about this.
Yeah, how'd you guys start?
Mine was a mix of relationships that I had throughout my life, my professional career. So some of them I just know them for a long time. They're entrepreneurs or former bosses I've had who maybe have built a private equity firm or built a company. So I have some of those, and then I have the other half are people I met during my fundraising process. So I would say my biggest advice would be build a lot of relationships with people who have the ability to invest while you're searching, so that way you don't have to scramble at the end. And I guess one other piece of advice I would give is assume at any given time that some of these people will not invest, even some of the people you think you have the closest relationship with, for personal reasons, for their own business reasons, may not actually end up investing. So if you have too few eggs going at once, like you set yourself up for issues. So I would say have as wide of a net as possible, build meaningful relationships, but don't over-invest in having like 2 people and you bank on them coming through with equity, or you're not gonna be able to close your deal, because there's a decent chance someone may not invest when it comes to the end.
My relationships were formed during business school, so like I guess a little bit different, but to try and make it practical, I think that like it just like kind of be direct about what you're asking for. And so if there's a couple investors that, I don't know, you've heard of, you've seen their content, it's like, hey, I'm doing a self-funded search. I'd love to start building relationships with investors when I have the, so that I can make it easier to raise money when I need to. Like, are you open to a call to introduce myself and then maybe talk once a month from there, or once every other month? Just like ask them, right? They're like, hey, I'd like to pick your brain. No one wants to read that email, but if you're direct, think about the investor seat. They'd rather have a free conversation every other month than, have to put in money up front, perhaps. So just be direct.
And I think spending a meaningful amount of your time doing that would be worthwhile. I don't know if the answer is 10%, 15%, but I think while you're searching, doing that would pay fruits. And I think Chris's approach of, I would cast a wide net to people to have that intro conversation with, and then keep a lot of people warm. Even if, like, I know a lot of traditional searchers send their investors, monthly recaps of what they're doing. Like, I think you could do that as a self-funded searcher too. So have a bunch of people you've started a relationship with and update them all in your search every month. Like, here's who I've reached out to, here's my contacts, blah, 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 blah. That would be a very smart approach, in my opinion.
Yeah, investors are in the game of building relationships with people that need to raise money. So like, I think they're more open to it than you think, even traditional search fund investors.
So I'll add some comments here. So I think that you should approach your search for investors similarly to how you think you would approach your deal sourcing. You should have some proprietary outreach. You should do some cold calling to investors. You should use as many resources as you can. So some resources, go to searchfunder.com, go to LinkedIn, talk to other searchers who are in their cap tables. It doesn't matter what style of search they're doing. If they're traditional, ask who their investors are. If there are other self-funded deals who have closed, ask who their investors are. You should talk to your lenders. They're a great source of investors. You should talk to your other service providers. You should talk to the attorneys. You should talk to your QOV providers. We are all, this is a relatively small space, let's be honest here. We all kind of know each other. So, we can definitely make recommendations, and the more that you can reach out to other people to build that network, the better off you're going to be in the long run, and it will pay benefits down the road. And definitely call them in advance. As an investor, about half the people come to me with a live deal, like under LOI, and they think I'm going to close in 12 days. And the reality is I'm not. Like, as much as I like you, I'm not going to do that for you. So, come talk to me in advance. I would highly recommend talking to your investors and all your providers in advance to build those relationships, and don't just dump something on them.
Can we have one more question, Andrew? One more? One more question. Who's got one? Oh, that's it? Oh, okay.
If you're introducing this to a family and friend, or someone that isn't as familiar with this model, how do you start to explain the economics? I know you're talking about press and IRRs. Now, how do you at a high level explain it to familiar with those terms, if they're not in PE or the search fund?
Chris, Aizik, how did you do it?
I didn't go through that experience, so I can guess, but if someone has more direct experience.
I've not had that problem.
Isaac?
I don't. I ended up not having any. I mean, I have, again, some family members, but we'll exclude that. It's a bit different. I don't have anyone really in my cap table who's not a professional investor in some way or experienced professional investing. But I did talk to some who did not, and it would have been a different model. I don't know. I think it's hard. I think you have to educate them, like you said. I think that's what makes, common structures, I think, easier to communicate. If you could say, hey, like, I have a 10% pref, and Chris is a little bit different because his picks, but if it doesn't pick, you could say, hey, I'm going to pay out 10% a year on your investment, and here's the upside, here's the risk. I mean, I don't know.
So I would say if you do know folks who are doing traditional searches, they have to write PPMs. I would say look at those PPMs. Almost every PPM I've read has a great description at the beginning about the search process. Just crib part of that, honestly, and I think that's a great start.
But also, I think it's good practice to learn how to speak about this in non-finance terms, because, quick piece of advice, my deal almost blew up because there was stuff in the LOI with the seller that I thought he understood. His accounting business, he's going to understand what this means. He didn't, and we got through it, but especially in LOIs, especially in self-funded, you got to speak in layman's terms, not finance.
Great. Time? All right. Well, thank you, everyone. Thanks for coming. Thanks to the panel.